and find out how, or rather what your portfolio strategy should be for the day. Neeraj, hi, good morning. Good to have you on the show. Neeraj, I think the question is now really about your core portfolio, right? The momentum portfolio, most have already exited if they were in the money. But do you touch a core portfolio at this time? Do you try and protect capital? Because the world seems to be going through a very, very sort of, unstable state.
Yeah, good morning. Yeah, definitely there is a lot of instability because of the tariff talks. The people were hopeful that something may happen before the actual date, but then I don't think anything is happening. There tariffs have been imposed and there are counter tariffs. So I think this thing, what we've been fearing is true right now. But I don't think one should be really touching at the core portfolio. I think the core portfolio should stay because there is definitely a lot of fear on the street. People, what 5, 6 months back, there was a lot of greed, but now that is converted into so much fear and no one really talking about buying anything. Everyone's talking about, what to sell. Now, you even asking me question about the core portfolio, that whether one should sell that also and sit on the side. But I think one should just, if one is invested their own money and there's no hurry for them to liquidate, there's no immediate requirement, and one can stay invested for a couple of years, I think one should stay invested in the core portfolio. And even if suppose market is coming close to 21,800, and if it's coming below that also, I think one should start slowly adding also more below that level.
No, I'm asking purely because I'm guessing the viewers would be in panic mode looking at, now the global market correction as well, which has begun, it seems. Other than that, Neeraj, the question also is, do you now start buying on declines and do you keep that large cap tilt? And I'm talking purely about core portfolio holdings.
Yeah, absolutely. One should only be investing the money that the person can spare for a couple of years. One should not be investing just for a bounce back. A bounce back may not come immediately. Market may keep on drifting down, or market may make a bottom soon and start consolidating. No one really knows the answer to that question because we are in the middle of a turmoil which is happening because of trade talk. And domestically also, in the second quarter result, third quarter also, were not that great or better than the second quarter. So, till that narrative changes domestically on growth, we're not really sure on whether we bottomed as far as our growth is concerned. And of course, you're in the middle of a turmoil which is happening globally. So if you are an investor willing to invest for a couple of years, I think, even if you see equity market return, if you see that if suppose pre-COVID, we were at 12,300, 400, even if you take a 15% annualized return, leaving 1 year in between, that COVID 1 year, nothing happened, till you should be somewhere around 21,700, 800 levels. I think so. If the market is falling below those levels, I think one should be accumulating on those dips.
Right. That's the take coming on the markets. But Kunal, I want to get a quick chart check on Reliance Industries because that one actually dragged the Nifty lower. Along with the markets recovering, it was Reliance also that recovered a tad bit from the day's lowest point. But what's your take coming in on Reliance Industries? How are the charts looking for this one? I think on an intraday basis, it went to a 3-year low, right?
Yeah, it went to a 3-year low. I think it went to 1160 or 1150 thereabouts on the spot levels, and still looking very weak on the charts. I think what's concerning for Reliance Industries is the fragile nature of the stock price, because we've seen the stock being absolutely solid in terms of the previous trends. Whenever the markets went to a correction, the stock used to just about go into a sideways range. But then we are at a point where the indices are on the verge of critical break of support points, 22,000 odd mark. And I think in that sense, we expect these large cap names, which have already fallen by more than 25%, 25-30% in the last 6-7 months. These stocks, they generally tend to stop the falling nature of themselves. But then the fragile nature of the stock price trends for Reliance Industries indicates that the selling is not over and we could expect the stock to drift lower.
Okay, that's that on Reliance. Also, Neeraj, right now one is wondering about the prospects of IT, right? Because of the uncertainty emerging from US, would you say it's safest to avoid IT as a sector?
Yeah, I've been saying that for the last 2-3 weeks only, that one should right now avoid IT. One should let things stabilize or get some clarity on what the US view is and how things will pan for the IT space. I think one can avoid IT for the time being and look at other sectors which are more domestically focused.
Right, so that's the take coming in on the tech space. Wanted to understand your view also coming in for the auto and pharma space in particular, Neeraj, because when you talk about tariffs, these two sectors are also in focus, given the fact that we could see some reciprocal tariffs on those sectors for India as well come April 2nd. What's your take coming in on that one? Do you think that given the fact that we could see some moves on the tariff front on the pharma sector, should we go in for this one right now or avoid it? Because what we're expecting that the tariffs wouldn't be that much on the pharma space, Indian pharma space in particular.
Yeah, I think first automobiles. I think automobiles also, there is a lot of fear about tariffs. I think that is mostly maybe happening more towards the auto ancillary part. Very few of the OEMs would be impacted in a large way because of that. So I think domestic players like Mahindra, Maruti, I think they are also correcting right now. So the correction in those names I think can be used to accumulate slowly. The idea is to accumulate, not to really go and buy outright. Buy as the market is correcting and slowly pick it up as in when you saw a dip in the market. And second is the pharma space. Pharma space, one can be stock specific. There is that API space where you saw good numbers coming, and they have a good presence, globally also. So they may get impacted a bit, but then one can be stock specific in that space. So pharma, there is a talk that they will also be impacted. We don't know to what extent. So till you get overall clarity, one should not be going all out into pharma and be very, very stock specific there.
Okay, be stock specific.
Neeraj, I wanted to understand which are the themes that you are looking at very closely, and if there is an opportunity, you would actually go in and park your monies right now.
Basically, I'm looking at only long-term investing right now, and I feel that there are opportunities in the domestic focus sector, the domestic financials, even the PSU banks there, or the NBFCs. Then our domestic focused, infrastructure companies, water infrastructure companies. Then there is, even your consumption names like hotels, or even some of the FMCG names like ITC or a Britannia or a Godfrey Phillips. I think these are mostly focused on Indian consumption and India infrastructure. I think these are the things which I feel that because when markets correct, everything falls like anything. And these also, these names are quite high beta, so there can be a harder fall there. So these can be accumulated. I think these are the sectors where, though there will be a short-term turmoil because of global headwind, but domestically, I feel that there's a strong case that our growth, which had faltered in the last couple of quarters, may have bottomed, and you may see an upward trend from these levels. You saw the GDP numbers, you saw the auto numbers. There were some encouraging numbers which came from that. And plus, even even inflation is in control. Interest rates, can come down further going ahead. RBI is infusing liquidity, and they may continue doing so. So all these factors can augur well for our domestic focused companies and sectors.
Interesting. Just looking at the market texture right now, Kunal, let's get your thoughts in on the Nifty Bank, because yesterday, along with Reliance, it's those private banking names, and we were chatting about it last afternoon, that also caved in.
Yeah, so I think, but on the Bank Nifty chart, we have retested the lows. 47,800 has been tested 3 times in the last 3 months. I think December, January, as well as February. These are the 3 times when the Bank Nifty tested this support level. And apparently in the previous 2 attempts, when the index had actually retested that support, we saw a bounce of almost 1,000 to 1,500 points on the index. So broadly, when we look at the charts over the last 2-3 months, Bank Nifty has been more resilient. The index has been more trading into a range. 47,800 as a support, 49,500 broadly as a resistance for the index. So we were expecting that if this time also the index manages to take support at this point, we could be looking at the index bouncing back quite smartly. And of course, many of the large cap private sector banking names so far have been resilient. So yes, yesterday of course HDFC Bank was at the receiving end, but then when you look at the last 2-3 days of price performance on a net-to-net basis, the stock has been absolutely flat. Same is the case with other names like Kotak Bank and Axis Bank, etc. When you look at their price performance, so I believe largely the private sector banking stocks have been relatively very strong. But if the bank nifty breaks below this 47,800 mark as a support and closes below this, then we could be looking at a further aggravation of a sell-off, especially led by the PSU banking end.
Right, so that's about private sector banks and banks in particular. Naresh, let me come to you and ask you about real estate sector. What exactly is happening there? Because it's been weak for a while now. Looks like all that euphoria, enthusiasm that was there in the sector is down and out now.
So real estate always has been a sector which is high beta, and we've seen a correction in the markets, and that's where real estate had outperformed from 2023. So the index itself went up almost 2.5 times, roughly from the March 2023 lows, and we are back to the price point where we were almost a year back. So for now, it looks like we are getting into a phase of a deeper correction, stock specific wise. And it's already corrected almost 25-30% from the top. So may not be a lot of downside here, but we are yet to form a major base. So for now, it continues to be a drift lower.
All right, so that's the take coming in on real estate, that chances are that it may drift lower going ahead. But Neeraj, what's your take? Are you watching this space very closely? Because Chris Wood is of the opinion that the real estate cycle is not over as yet. He's still bullish on it, though the market commentary or the sentiment is that is pretty negative on the real estate space. What's your view on the real estate space?
I think, what we've seen here is that, stock markets, real estate, they all move in tandem. So we've seen a good correction in the markets. So, a lot of money which is going into real estate is not going that to that extent. And there is definitely, though the prices have not corrected, like I'm in North, so I can say about NCR region. The prices have not corrected, though maybe what we are hearing that there may be some deals. So some negotiations are happening, so you get some discount. But as such, builders are holding on to their prices. So I feel that because you've seen this negative sentiment, and this has been going on for the last, I think, 4 or 5 months now. So post Diwali, like we're expecting something to pick up in Diwali, it didn't pick up to that extent. But still, the builders have been able to sell off, and their launches have been good. So I think that post this correction, which very difficult to say whether the stocks have corrected enough and they made a bottom. It's difficult to say that, but they may be close to a place where they should start consolidating. So I think if one is a long-term investor, this is also a domestic focused, our own domestic focused consumption story, and I think there is definitely scope there to build on to a portfolio. If you're seeing some correction and consolidation started to happen, then one can be looking at real estate also.
Neeraj, it was a mixed report when it came to the auto sales for the month of February. While tractors saw an uptake, passenger vehicles, you didn't have the best of performance from a Tata Motors, from a Hyundai, or for that matter, even Maruti. But then again, M&M was a winner through and through. Tell me, how is it that you're analyzing right now the entire auto construct?
I feel that what happened in the budget also, so that will also help the auto companies going ahead. So there is fear that duty cut will happen. There'll be competition coming in from outside India. That may happen. Then those companies that come into India, for them to settle down and to come to a reasonable scale of what Maruti and M&M in a four-wheeler space, passenger space already have, is going to take a long, long time. And the kind of volume that M&M does or Maruti does, it's very difficult to come close to, a fraction of that also so soon. So I think once, according to my understanding, auto space should do well. Numbers, there were a lot of fear that the numbers will be really bad. But when you saw M&M numbers, Maruti was not that great, but it was not as bad as people were fearing on the street also. So I feel that these are opportunities for these companies. I think from here on, though the numbers may not immediately start showing a good uptick, but I think they would start showing some improvement that they saw in the previous quarter.
Right, so that's the take coming in on the auto space. I wanted to understand your view actually in particular when you talk about the financial theme, Neeraj, because right now everyone's only talking about financial theme as the next go-to sector, the one that is looking fairly valued at this point in time. What's your take coming in on the financial space? And in financial space, where would you actually park your money? Will it be the NBFCs? Will it be the capital marketplace, or your pure banks, and in banks like the private sector bank or the PSU space?
So one is that strong private sector banks definitely is that is one space one should stay invested and should be looking at opportunities if there are dips there. And second is the PSU space, PSU banking space. PSU banking space, you go to the good managed banks, the ones which have been showing better numbers. State Bank definitely is top of the pig that is there. And besides that, also there are smaller banks like below State Bank. You can look at PNB, which last couple of quarters the numbers have been good. Asset quality is now not deteriorating; it's improving only, and they have good assets, good recoveries that are happening for them. So then, even look at banks like a Bank of Baroda or a Union Bank. So besides the space, the capital market, I would look at asset management companies. So that is where, though they are correcting right now with the markets correcting, they may correct a bit more also if markets don't make a base and start consolidating and going up. But there, they have long-term, you've seen that long-term money is still coming for asset management companies, and there they have strong compliance, strong franchisees, which will go through this slow phase and they come back stronger. And with the cut, they also you link it to the tax cut that happened in the budget. If there's more money, more investment can happen, so that can also gradually improve for them. So these are the kind of themes I'm looking at the financial space.
Right. Okay, Neeraj, so good having you on the show. Thank you, as always, for your time. Bracing
Thank you.
ourselves for the pre-open rates, the implied open.
If you like this video, then like, share and subscribe to ET Now.